Current market action for Navitas Semiconductor, ticker symbol NVTS, is showing a distinct downward pressure as we move through the trading session here on Tuesday, December 2, 2025. The stock is currently trading right around the $8.29 mark, specifically sitting at $8.30 at this exact moment. That represents a decline of roughly 5% on the day so far, with the stock sliding 45 cents from the open. We are seeing volume already pushing past 14 million shares, which is significant and tells us there is a lot of turnover happening right now. Hands are exchanging this paper rapidly. The intraday range has been tight but bearish, bouncing between a low of 828 and a high of 876, but spending most of the afternoon pinned near those lows. If you are watching the tape, you are seeing a lot of red, and the immediate sentiment feels heavy, almost as if the market is punishing the stock for something that goes beyond just today's news cycle. It's an ugly chart for the day and for the last month, frankly, but that is exactly why we need to stop and look closer. Most investors looking at this sea of red on their Fidelity mobile app or their Robinhood trading screen are seeing a company in trouble. The expectation right now is that Navitas is a broken growth stock. You look at the headlines and it's easy to construct a bear case that sounds airtight. They just missed earnings estimates for the third quarter of 2025 back in November. Revenue came in at $10.1 million, which was a miss. Earnings per share were -9 cents, another miss. On top of that, you have directors like Brian Long and executives dumping shares, millions of dollars worth of stock sold in late November. When you see insiders selling and earnings missing, the natural human instinct is to run for the hills. That is the expectation. Navitas is a cash-burning small cap that is getting crushed by the weight of its own ambition. But here's the reality that the market might be missing while it fixates on the short-term pain. Navitas is not just a company making chips for phone chargers anymore. The Navitas 2.0 strategy that CEO Gene Sheridan has been preaching is not corporate fluff. It is a fundamental restructuring of the business to align with the single biggest demand driver in the history of technology: AI data center power. While everyone is chasing NVIDIA stock for the compute or looking at Tesla stock for the autonomy, the physical infrastructure required to power those chips is hitting a wall. The reality is that Navitas is positioning itself to be the breaker of that wall. The drop you are seeing today might not be a death rattle, it might be the chaotic repricing of a company shifting from a consumer electronics supplier to an industrial energy player. Let's dig into what is actually moving the stock today and over the last few weeks, because the context is vital if you are managing an individual brokerage account or looking at this for your Schwab Intelligent portfolios. The recent drop is partially a hangover from that Q3 earnings report I mentioned, but it is also heavily influenced by the capital raise. In early November, Navitas announced a $100 million private placement. Whenever a company raises cash like that, it dilutes existing shareholders, and the market generally hates dilution. It feels like your slice of the pie just got smaller. However, you have to ask why they raised the money. They didn't raise it just to keep the lights on. They raised it to fund the ramp-up of this new strategic pivot. They are moving away from the lower-margin mobile market, things like fast chargers for phones, and going all in on high-power markets like data centers, EVs, and the energy grid. This is a capital-intensive switch. They need to build inventory, they need to secure capacity, and they need to fund R&D. The market is punishing them for the cost of the renovation, but it hasn't yet priced in the value of the finished house. Furthermore, we have to talk about the partnership news that hit recently, which is arguably more important than the earnings miss. Just a couple of weeks ago, Navitas announced a massive strategic alliance with GlobalFoundries. This is crucial for two reasons. One, it secures U.S.-based manufacturing for their gallium nitride, or GaN technology. In a world where geopolitical tension is high, having a secure domestic supply chain is a premium asset. Two, it validates their technology. GlobalFoundries is a major player. They don't partner with duds. They are gearing up to manufacture Navitas's technology specifically for AI data centers. If you are bullish on AI, you have to understand the power problem. A rack of NVIDIA H100s or the newer Blackwell chips consumes an obscene amount of electricity. Traditional silicon chips simply cannot handle that voltage efficiently. They get too hot, and they waste too much energy. This is where Navitas comes in, with GaN and SiC. These materials can handle higher voltages and switch faster than silicon, meaning less wasted energy and cooler data centers. The market is selling NVTS today because the revenue from this shift hasn't shown up on the balance sheet yet, but the infrastructure to create that revenue is being built right now. This brings us to the core of what Navitas actually does, because it is often misunderstood by people who just browse investing sites or skim headlines. Navitas is a pure-play power semiconductor company. They focus on two materials, gallium nitride, or GaN, and silicon carbide, or SiC. Think of traditional silicon chips as a standard four-door sedan. They are reliable, they work, and they have been around forever. But now we're trying to drive at 200 miles per hour on the Autobahn. The sedan can't do it. The engine will blow. GaN and SiC are like Formula One cars. They have a wide band gap, which is a fancy physics term, meaning they can withstand much higher voltages and temperatures before breaking down. Navitas became famous for GaN Fast, which was essentially putting this Formula One engine into mobile phone chargers, allowing them to be tiny and charge your phone in 20 minutes. That was Act 1. Act 2, or Navitas 2.0, is taking that same technology and scaling it up for massive industrial applications. We're talking 800-volt architectures for electric vehicles, which allows for faster charging and longer range. We're talking about the power supply units inside server racks that run ChatGPT. Every time you ask an AI a question, a massive surge of power happens in a data center somewhere. If that power is managed by silicon, you lose a percentage of it to heat. If it is managed by GaN, you save that energy. Over millions of queries, that saves billions of dollars. That is the value proposition. There is also a significant development regarding their silicon carbide portfolio that dropped just yesterday, December 1st. Navitas announced the sample availability of new 3300-volt and 2300-volt SiC products. These are ultra-high voltage devices. To put that in perspective, your wall outlet is 110 or 220 volts. These chips handle thousands of volts. This is not for consumer electronics. This is for the electrical grid itself, for high-speed rail, for renewable energy storage systems. This is heavy industrial tech. By releasing these products, Navitas is signaling that they are ready to compete with the big dogs like Wolfspeed and onsemi in the most demanding environments on Earth. The market reaction today, that 5% drop, suggests that investors are skeptical about whether Navitas can actually sell these chips against those entrenched competitors. It's a show-me story. The technology is impressive on paper, but Wall Street wants to see purchase orders, not just press releases. We also need to address the insider selling because it's the elephant in the room. When a director sells almost 90% of their holdings, as we saw with the recent filing, it looks bad. It scares retail investors who use Fidelity Brokerage or SoFi Invest to manage their retirement account. However, you have to look at the context. Often, early investors and directors have to liquidate for personal reasons, or because funds have a mandate to close out positions after a certain number of years. While it's never a good signal, it's not always a signal that the company is dying. It creates a liquidity event that drives the price down, supply exceeds demand, temporarily, which can sometimes create an entry point for those who have done their homework. The question you have to ask yourself is, do you trust the director who is selling, or do you trust the CEO who is pivoting the company towards a trillion-dollar AI opportunity? Let's shift gears to the macroeconomic picture because Navitas does not exist in a vacuum. The semiconductor sector is notoriously cyclical. We've been in a bit of a downturn for industrial and automotive chips, which has hurt companies like Texas Instruments and Analog Devices. Navitas is feeling that pain too. High interest rates have made it expensive for companies to invest in new capital equipment, which slows down orders. But the one area that has remained immune to the slowdown is AI spending. The hyperscalers, Amazon, Google, Microsoft, are spending unlimited money on data center buildouts. Navitas's entire bet is that this spending will spill over from just buying GPUs to buying the power systems that run them. If that thesis holds, the macro headwinds in other sectors won't matter as much. I want to pause here and ask you a question because your sentiment matters as much as the data. Comment below, do you think the AI power crunch is a real thesis that will drive stocks like Navitas, or is it just another hype cycle that will burn out? And while you're at it, let me know if you hold any shares of Wolfspeed or onsemi, as those are the direct comparisons here. I'm curious to see how you're playing the power chip sector in your own online investment portfolio. Now, looking forward, what are the catalysts?